Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, February 28, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And it was an interesting day out here today. It was relatively quiet for the majority of the trading day, although the market did get thumped into the close with a pretty good hard sell at the end of the trading session. What you'll notice is the level that we talked about on the downside last night was 271.25. That's where I saw the market going at a maximum today of the downside, and the low today was actually put in at 271.29, just 4 pennies above that level cited last night. Pretty interesting information. And that's not a secret level. Anybody that's taken my course at lazyeMiniTrader.com is able to identify why that level was important. There was a couple of reasons surrounding that level which led me to the 271.25. Where do we go from here is the important question. Is there more downside coming, or is this all the downside we're going to see in the short run, and are we going to see a reversal back higher in these markets? And frankly, it's all going to depend on whether or not we maintain on a daily chart closing basis above these levels here. If we close below those levels, these pivot lows down here, then the market is going to be prone for more sell side action, probably testing at a minimum of the 100 period moving average that comes in right here. And if that doesn't hold, look out below. We could actually go test the old lows. I don't necessarily suspect that's going to happen right now. However, tomorrow's going to be an important trading session to see whether or not we actually hold this level, or do we go and test these lows down here from several days ago. Let's let the market build some evidence, build some more clues, take it one day at a time. What we don't want to do is impose our will on the market. We don't want to make assumptions and hope the market makes it to or achieves our assumptions. We want to let the market give us the evidence, give us the clues, and we can draw conclusions based on exactly what the market is telling us with a high degree of certainty, with a high degree of probability, the majority of the time. In fact, that's how I came up with the 271.25. Markets love to come back and test former breakout and former breakdown areas. The 271.25 area was an important level on the chart, which puts this market at a critical juncture coming into tomorrow's trading session. And that'll tell us a lot. Are we going to trade beneath the former breakout area that just happened a few days ago? Or is that going to hold, and are we going to take another shot to the upside? We'll see what happens tomorrow morning, but at least we know that the markets are acting normal, right? The market came down to test the level we talked about, 271.25. It was a level that I expected the market to test. And why did I expect it to test that? Well, this is how the market works under normal conditions. All these are discussed in the course at Lazy E-Mini Trader. So the market is trading normally. The market is trading very technically sound. It's trading very normally. Let's go take a look at an intraday chart, because there's some things that are still very interesting in this market. So you'll see what happened. We broke down earlier today into the 11 to 12 o'clock time frame, and then we rallied up. And where did we rally up to? We rallied right back up to right around the 275.50 area, slightly above it, but not by much by any means. You can see here, this is where the market was contained, and this is where the market failed one more time. And here's another thing right out of the course at Lazy E-Mini Trader. What happened was we had the makings of a breakout. We had the makings of another bullish consolidation. So here's what happened. So the market had a big green up candle, okay, and we held that low by far. We had another up move. Then we held this low, and we consolidated for a period of time. We made another up move. The market began to consolidate again, but broke down, closed below the low of this green up candle, and that was a negative sign for the markets. That's, in a sense, what told us that the downside was coming in the afternoon session. Again, all this is discussed in the course. taught in detail in the course at Lazy E-mini Trader. So once again, we saw the market have a resistance level at 275.50. First, it's a support level. We gapped above it all the way back here the other day. We back tested it. The market took off to the upside. We came in and back tested it again yesterday, right? We made a consolidation. Whoops, I didn't mean to do that. Let me wipe that off the chart. We made a consolidation right above that level from the top side of it. That told us that that level was going to be diminished because we consolidated right around and above that level. We broke down, we rallied back to test it again, and we failed and we broke down again. That tells me that this general zone, at least 2 times right now, is important to the market, okay? So now, what was once support back here is now resistance to the market. All these things are garden variety technical information that you should learn, because this is how the market trades over and over and over again. Doesn't matter whether we're looking at the spider chart, doesn't matter whether we're looking at a commodity or a futures chart or a chart of any stock under the sun. They all act and react the same way. This is how markets trade over and over and over again. Doesn't matter whether we're looking at a 10-minute intraday chart, a daily, weekly, or monthly chart, an hourly chart. Makes no difference. They all act and react the same way. Just to get another view of the activity from today, you can see here that we had the down move off the top. We had sideways consolidation for the majority of the day today, in and around that 275.50, and then the breakdown. And the breakdown came in right to the 271.25 level we discussed last night. Pretty interesting, and also pretty fascinating when it comes together exactly how we map it out the day before. Although there was one caveat. I thought we would have a hard sell in the morning. At least that's what I was looking for. And the fact that the market came into that level at the end of the day leaves the market in somewhat of a weaker position. I think if we came into that 271.25 this morning, early in the day, I think we would have had a nice rally off that level. Now, not so much of a clear picture leading into tomorrow, whether we have further selling into Thursday's session or do we still bounce off this level? Because remember, it was the last breakout level that we saw, and the market came back and did what it's supposed to do. It came back to check in at a former breakout area. Now we're going to take a look at the IWM. So there's some interesting activity in the IWM. First off, the IWM was weak. It was the indication that the market was weakening all day long. The IWM was certainly the weaker index as it relates to and relative to the spider chart. Okay, the IWM was down 1.5% today. On low, the spider was down 0.9, or on close, I should say, the spider was down 0.9%. The S&P 500 actually finished down 1.1%. The Dow finished down 1.5%, similar to the IWM. And the NASDAQ was actually showing signs of strength, finishing, the composite finished down 7 or 0.8%. But here's the interesting thing. The IWM was the weaker index today. So we had a nice sell day yesterday. We had another big sell day today, finishing below the moving averages, below the 20 and the 100 period moving average, but still above the 200. But here's what we did. We closed the month below that important trend line that's drawn over from the monthly chart that and if you've been with me for any long period of time, you know that I've been watching this trend line literally for years. And we closed back below this trend line for the close of the month of February. We started talking about it about 3 weeks ago. I was watching to see where this was going to close at the end of the month. So I was watching it each and every day, keenly interested whether we were going to close above or below this trend line. The fact that we closed below this trend line could have meaning to it in terms of a failed breakout in the IWM. We'll need some more evidence, but this is the first indication that we have a failed breakout on our hands. And remember, from several days ago, we began discussing the fact that the IWM was not leading the market on the upside when the markets were rallying from the oversold conditions. So the oversold conditions down here, the market started rallying up, and the IWM was going up less than the other indexes. We talked about it at the time, and I said that's something that we have to watch out for because traditionally the IWM is going to lead the markets either in the upward direction or on the flip side in the downward direction, and the IWM was not leading the market higher. I raised a caution flag when that happened, and here we are. The IWM once again was the canary in the coal mine. I wouldn't be surprised to see some more downside activity in the IWM down to about the 149 level. We begin getting below the 149 level. This comes into play. The 200 period moving average comes into play right here. And then, of course, double bottom comes into play right here. But we're a far cry off from that. Right now, I would like to see if we're going to see the upside continue in this market, at least in the short run. We've got to have 149 hold, I think. And if it doesn't hold, then it's imperative that this green candle low holds. If that doesn't hold, then the odds favor us testing double bottom. And if the IWM is selling down to double bottom, so is everything else. All right, next up, we're going to take a look at the Dow Jones Transportation Average. The transports are my second favorite leading indicator. And the transports look very similar to the IWM, look very similar to the spider chart. We had a nice sell day of 141 points down in the transports, and we're approaching the 100 period moving average. I think this would be, at least in my opinion, a fait accompli. Any hint of selling pressure into Thursday's session, and we should hit the 100 period moving average in the transports. But again, not a lot's changed from the outlook from yesterday. We talked about the fact that the transports completed their zigzag or ABC pattern, and upon completion, which is a high above the high of the A leg, we did that. We traded right into the 50 period moving average. We're rejected, now trading lower. No surprises. When everything sells, everything sells. Your S&P finished down 30 points. Your Dow Jones Industrial Average, the Dow, finished down 380 points, and therefore it makes total sense that the transports were down pretty heavy also, 141 points. Last night we took a peek at the XBD, which is the broker-dealer index, and we took a look at the tail candle. We talked about it, and what happened today? It's interesting, and I think you need to pay attention to this because it's another one of those things that's taught in detail in the course. We had a garden variety retracement of the tail candle today. So tail candle was put in yesterday's high. We retraced about halfway home, and then we sold off, and the tail candle from yesterday is doing precisely what it does the majority of the time, marking at least an interim or short-term top, at least based on the daily chart. Now, it doesn't mean that the total trend over the longer term has changed. The trend is still up, but we could certainly trade lower in the XBD. For us to trade down into the moving averages is fine. It doesn't necessarily damage the longer term uptrend in the broker-dealer index. For example, when you look at the weekly chart, okay, this is still in a weekly chart uptrend, and that wouldn't be damaged for quite some time. We'd have to have significantly lower prices. Remember, what did we do here? We came in to test the 20-week moving average, but the weekly chart uptrend was not damaged at all. This is still in an uptrend. But on the daily chart, we put in a tail candle. There's nothing that says we can't go down from a tail candle for 3, 4, 5, 6, 7 days, or at least go sideways and down for, several days. So that tail candle was the tip-off. That was the signal of a trend change, at least in the short term, if for nothing else, in the XBD. It was the tip-off yesterday. We had a retracement earlier today, and then we sold off. And I'm telling you, folks, this is textbook charting 101. Again, everything that you see on this chart was taught in the course at Lazy E Mini Trader. Very easily identifiable. We'll take a look at the gold chart now, and yesterday's close officially was below the low of this up candle, which is 1319 spot 10. Yesterday's close was 1318 spot 60, and here we are fighting that level yet again. So it wouldn't be out of the ordinary, and I think I mentioned last night that we could put in another bearish pattern. I'm not sure whether I mentioned it on the video or to one of the traders that emailed me about the gold chart, but we could put in another bearish pattern from this down move, bearish pattern, and another down move. That's a distinct possibility. That could happen, or we could just have a hard sell. Either way, I think lower prices are coming in the gold market sooner than later. The only way that lower prices get taken off the table is if we close above yesterday's high. That comes in at 1338 spot 40. Yesterday's high right here. If we close on the daily chart above 1338 spot 40, above yesterday's high, that takes some of the downside, or it takes the immediate term downside off the table. We would have gotten back above both moving averages. The 50 is the blue line, the 20 is the red line. So that would be bullish behavior if we could do that. I'm not sure we can do that. I think the downside has the most probability that's in front of us right now on the charts in the gold market. All beginning with the close yesterday below 1319 spot 10. We were watching that level pretty intently for a while, and yesterday they did it. There's a little symmetry in here that developed in the gold market, so we'll talk about that for a second. This is another thing that's also gone over in detail in the course. So you have this down move, then you have a sideways bearish wedge pattern, another down move that's around, it's not exactly equidistant, but it's around equidistant, okay? And when you see that, that's likely that the market's going to pause there for a while. When you see a symmetrical move complete, that means it doesn't necessarily mean we can't have further downside right now, but what it does mean that a lot of the time the market's going to pause there and most likely, in this case, put in another bearish pattern off the completion of the symmetrical move. Either way, the pressure right now is to the downside in gold, in my opinion. At least that's what the charts are telling me. Will most likely be contained by the 50-period moving average. That's the blue sloping trend line. Taking a look at the crude oil market, decent sell day in crude oil, down $1.45 yet, 2.3%. Right now, the $64 level that we flagged the other day is turning out to be pretty formidable resistance. We'll see. If this doesn't hold right here, this bottom of the green candle here, then the upside is going to be in question for the time being. And if that doesn't hold, we could come all the way back down to that 58.25 area, or maybe slightly higher than that. You can see where the 100-period moving average is sloping up and is now slightly above the 58.25 area. So if this didn't hold, and that level officially is at the low is $60.75. If that doesn't hold, then it brings into the picture a potential test of 58.25, or it depends on when it happens and where the 100-period moving average is at the time, because you could still do a test, and this could be determined or considered double bottom. So you have a bottom here, okay, so we go up, and if this fails, we could do some kind of a retest, and doesn't necessarily have to come in exactly to double bottom. We could do a retest, have a higher low, and then take off from there. So we'll have to see how this chart develops in crude oil over the next few days. Anyway, with that, folks, it's everything I wanted to and intended to discuss tonight, so I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.